Gold just gave back nearly a quarter of its value from January's all-time high, and the people buying the dip aren't nervous retail traders. They're central banks, sovereign buyers, the institutions with the longest investment horizons on the planet, have been adding to their gold reserves at one of the fastest paces in years, even as the price fell. If you've been watching headlines calling this a crash or wondering whether $4,200 an ounce is the floor or just a stop on the way down, the data coming out this week gives us a real answer, and it's more interesting than most of what you're hearing right now. Today we're going to break down exactly why gold has dropped from its record high near $5,589 down to where it's sitting now, just above $4,200. We'll look at the two specific events that triggered this pullback, why the structural forces underneath this market haven't gone anywhere, and what this week's Federal Reserve decision could mean for where gold goes next. By the time we're done, you'll understand whether this is the start of something worse or whether it's the kind of pause that's happened many times before during this gold bull market. Let's start with where things stand right now. Gold is trading around $4,200 an ounce. That's down roughly 25% from its all-time high of $5,589, which was set back in late January. To put that in perspective, this is the deepest pullback gold has seen during the entire current bull run, and it's happened in a matter of months. But here's the context that often gets left out. Even after this drop, gold is still up more than 20% compared to a year ago. This isn't a market that has broken down. It's a market that ran extremely hot and is now working off some of that excess. Silver tells a similar story, just with more drama. Silver hit an all-time high above $121 an ounce earlier this year, and it's now trading closer to $64 or $65. That's a steeper percentage decline than gold, which has pushed the gold-to-silver ratio up to around 64. We'll come back to why that ratio matters in a few minutes, because it might be one of the more interesting signals in this entire market right now. Meanwhile, the US dollar index has been firm, and Treasury yields have moved higher, both of which typically create headwinds for gold in the short term. When the dollar strengthens and real yields rise, gold becomes more expensive for foreign buyers and less attractive compared to interest-bearing assets. That's part of the mechanical explanation for why gold has been under pressure. But mechanics only tell you what's happening in the moment. To understand whether 4,200 holds as support, we need to look at why this is happening in the first place. So let's get into the macro picture, because this is where the real story is. There are two specific events behind this correction, and neither one of them is structural. The first is an oil-driven inflation shock. Tensions tied to the conflict involving Iran have raised real concerns about energy supply, including talk of disruptions to shipping through the Strait of Hormuz. When oil prices spike, that flows directly into the inflation data, and sure enough, the most recent CPI report came in hot, around 4.2%. That single data point did a lot of damage to the rate cut narrative that had been supporting gold for much of this year. Markets that were pricing in multiple rate cuts for this year have now priced those cuts out entirely, and some traders are even floating the possibility of a rate hike before year end. The second event was a blowout jobs report. A stronger than expected labor market gives the Federal Reserve more room to stay hawkish because it removes one of the main justifications for cutting rates, which is typically a weakening economy. Put those two things together, a hot inflation print and a strong jobs number, and you get a market that suddenly has to price in a Fed that stays restrictive for longer than expected. That's exactly the kind of environment that pressures gold in the short run, because higher for longer rates increase the opportunity cost of holding a non-yielding asset. This wouldn't be the first time a hawkish repricing has triggered a sharp pullback during this gold bull run. At earlier points in this same cycle, gold has gone through double-digit corrections whenever rate cut expectations got pushed further out. And in each of those cases, the metal found its footing once the data softened and the rate outlook stabilized again. The pattern has been fairly consistent. A shock pushes expectations in a hawkish direction, gold pulls back hard and fast, and then structural demand provides a floor while the market waits for the next catalyst. There's no guarantee history repeats exactly, but the setup we're looking at now rhymes with what's come before. Here's the thing though, both of this cycle's latest triggers are event-driven, not structural. An oil price spike tied to a geopolitical conflict can resolve quickly, and there have actually been signs of progress towards some kind of resolution between the US and Iran. A single hot jobs report is also just one data point, not a new trend, and labor market data has a habit of getting revised. Neither of these changes the underlying forces that have been driving gold higher for years. and those underlying forces are still very much in place. Central banks bought roughly 244 metric tons of gold in the first quarter of this year alone, according to World Gold Council data. The People's Bank of China has now extended its gold buying streak to 19 consecutive months. What's particularly telling is that this is happening even as retail gold demand inside China has fallen to its lowest level in 16 years. In other words, the buying we're seeing isn't coming from excited retail investors chasing a rally. It's coming from sovereign institutions making long-term strategic allocations, and they kept buying right through this correction. On top of that, the fiscal picture in the United States hasn't improved. Deficits remain large, debt service costs continue to climb, and that's the kind of backdrop that has historically supported demand for gold as a store of value outside the traditional financial system. None of that changed because of one hot CPI print or one strong jobs report. So when you put it all together, what you have is a market where the short-term catalysts turned negative at the same time the long-term buyers kept buying. That combination is exactly what creates the kind of support zone we're now seeing form around $4,200. Now let's talk technicals and sentiment, because this is where 4,200 becomes more than just a round number. Several market analysts following this correction closely have laid out a range for gold this month that runs roughly from $4,300 to $4,725, with a base case somewhere in the middle of that range. On the downside, even in a scenario where inflation comes in hot again and the Fed leans hawkish, the consensus among many of these analysts is that a retest of 4,400 is plausible, but a sustained break meaningfully below that level is much harder to justify given how much structural demand is sitting underneath this market. On the upside, if the dollar weakens or geopolitical tensions escalate again, a move back toward 4,800 or higher is very much on the table. That brings us to the gold-silver ratio, which right now sits around 64. Earlier this year, that ratio was running closer to 55 to 60. A ratio in the 60 to 70 range has historically tended to show up during periods when silver is unusually cheap relative to gold, and in past bull market recoveries, that kind of setup has often preceded a stretch where silver outperforms. Silver's industrial demand, driven by solar panels, electric vehicles, and electronics, tends to reassert itself once some of the monetary and rate-driven headwinds start to fade. For context, a ratio above 80 would signal a much more extreme dislocation than what we're seeing now. At 64, silver looks relatively inexpensive against gold compared to where it's traded for most of this year. One more sentiment data point worth mentioning. Major institutional forecasts for where gold ends this year are sitting somewhere between 25 and 44% above the current price. That's a wide gap. It doesn't mean those targets are guaranteed to be hit, forecasts get revised all the time, but it does tell you that the institutions making these calls don't see this correction as a change in the broader trend. They see it as a pullback within an intact uptrend. So what should you actually be watching in the days ahead? The biggest event on the calendar is this week's Federal Reserve meeting. This one is significant for more than the usual reasons because it's the first meeting under the new Fed chair, and it comes with an updated dot plot, which is the Fed's own projection for where rates are headed. Current market pricing puts the odds of no change to rates at this meeting at around 97%, so the rate decision itself is essentially settled. What isn't settled is the dot plot. If the new projections signal a more hawkish path than expected, that could put short-term pressure on gold. If they leave room for rate cuts to return later this year, that could be the spark for the next leg higher. Beyond the Fed, keep an eye on any further developments in the Iran situation. Progress toward a resolution could ease the oil-driven inflation pressure that's been weighing on rate expectations, which would actually be constructive for gold over time, even if the immediate reaction in safe haven flows is mixed. And watch the next round of inflation and jobs data. After one hot CPI print and one strong jobs report moved this market significantly, the next data releases will tell us whether that was a one-off or the start of a trend. Now, to be fair, this isn't a view without risk. If inflation proves stickier than expected and the new Fed leadership signals a genuinely hawkish stance through that dot plot, including the possibility of additional hikes rather than just a pause, gold could see further downside before any real floor holds. A sharp and sustained rally in the dollar, or a meaningful slowdown in central bank buying when the next quarterly data comes out, would also weaken the support case we've laid out today. These are the specific signals worth watching, because they're the ones that would tell us this correction still has room to run. Here's the bottom line. The The drop from $5,589 down to around $4,200 has been driven by two specific event-based shocks: an oil-driven inflation spike and a strong jobs report, neither of which represents a change in the structural forces that have supported gold for years. Central banks kept buying through this entire correction. The fiscal backdrop hasn't improved, and the gap between current prices and where major institutions expect gold to be by year-end remains historically wide. All of that points to $4,200 being much closer to a floor than a ceiling, with this week's Fed decision as the next major catalyst to watch. If you found this breakdown useful, the best thing you can do is subscribe and turn on notifications, because these macro shifts move fast, and you'll want to see the analysis the moment new data hits. I'd also love to know where you think gold and silver are headed from here, so drop your own price target in the comments. I read every one of them. Tomorrow, we'll be breaking down exactly what came out of this week's Fed meeting and what it means for the next move in gold and silver. Until then, stay sharp, stay informed, and remember that in markets like this, the loudest headlines are rarely the ones that matter most.